Ladies and gentlemen, one of the most frustrating parts about being a SoFi investor is the lack of comparable stocks that you can compare directly to SoFi to compare their valuations. Do you compare it to legacy banks while also including all of their other parts of their business, like capital markets or business banking or all these things that could potentially affect their total multiple? Do you sort of compare it to Block, which has Cash App but also has a bunch of other businesses? What about PayPal or Robinhood or any of the other brokerages that might be similar to SoFi, but not quite encompassing quite the same level of products? This has plagued Wall Street for some time as they can't really find any peers to compare SoFi directly to, until recently, where this actually might change just in the next few weeks, as Chime is looking to IPO. And they've also released their S1. Okay. This means that we have all of the data that we need, at least for the last few years, and we can compare the success of Chime versus the great and powerful SoFi technologies. So although they do have some distinct differences, we can see this even in these first slides that show off both Chime and SoFi, is that Chime usually leads to a lower end FICO user or lower income user as well, but still they're going after a much larger audience, and those people actually have large potential for average revenue per user. We'll compare some of their individual products later on in later slides, but you can just see in these two individual images that these companies have put out themselves that in the spending accounts, they're marketing it towards people that usually have on average about $1,200 in their account. They're using that because it's relatable to their audience. Whereas SoFi, you're seeing that it's a completely different situation. These people have products in homes, personal loans, investing, and even in their banking has roughly around $25,000 in their checking and savings. Like I said, we'll go a little bit more in depth later on, but let's jump into the actual numbers and comparing the success of these two businesses over the last 3 years. Now, starting with members, we need to give a very big disclaimer. SoFi is showing off their total member counts, where Chime is only showing off their active member counts. Now, even including this, that means that the member counts for SoFi are growing about twice the rate. Now, if you were to look at SoFi's member count and then their active member count, which they do not disclose, but if they were, let's imagine that that statistic as a percentage of total members stayed consistent. That still means that the percentage of active members would still be around 41% because it's a percentage of the total account growth. Whereas Chime, assuming that their active member count is not dropping over time, which would not be a good statistic, this should still be similar to their total compounded annual growth rate of total members as well. But still, if we're looking at total member counts saying, oh, SoFi has 11 million members, Chime only has 8.6 million, that's not really a fair comparison. Let's say that the activity rate of Chime is around 50%. That means that they could have somewhere around 16 to 17 million total members with only 8.6 million actually on these charts. But still, that would be much larger than SoFi. And I actually suspect that they have more members than SoFi because they obviously rank much higher on App Store rankings. But if we dive in a little bit closer and take a look at new member ads, remember, this is SoFi's total new member ads, where Chime is showing off active member ads. Now, this is not completely true that like SoFi is signing up all these members and none of them are using the platform. If you are completely inactive on SoFi, they will remove you as a churned account. Okay, so these are the people who have actually stuck onto the account. SoFi's looks very consistent here and also staying above Chime, but it is good statistics showing that Chime has broken out of, sort of maxing out at 400,000 new accounts, and in the last 2 quarters have breached that, going up to 500,000 and 600,000 active new members. Very good sign for Chime in most recent history, and could also mean that the valuation that we're going to talk about later is also very justified for them. In terms of acquiring these new members, we have to remember this is SoFi's total member ads versus Chime's active member ads. Okay, so Chime could actually be paying a little bit less for total member ads, but then we're only counting the ones that are being actually sticking on the platform and being active. That still being said, they are pretty well in line with, SoFi beating out in certain areas and Chime beating out in other ones in terms of which ones are getting more efficiency per quarter. It's not like SoFi versus Nubank, where Nubank is bringing in customers for under $10 and SoFi is bringing in customers for over $300. These are actually pretty even. Now, for total revenue, which is completely excluding any sort of total versus active member counts or anything along these lines, regardless of that sort of count, this is what these companies are doing. SoFi's 3-year compounded annual growth rate on revenue is nearly 33%, where Chime's is just around 29%. They're actually pretty comparable in these two areas, but still, you got to give the edge to SoFi. They are pumping out better numbers here. And then in an average revenue per user, which does have to be differentiated because SoFi's is total member and Chime's is active member, we still actually see a higher upside for SoFi. Now that's coming down a little bit, and I'll explain that here in a second, but it still is important to know that this so heavily favors Chime because it's only counting their active members, where we have to count even the users that might not have used SoFi in the quarters that we're actually, dividing the revenue out by. But overall, the reason why you see the average revenue per user going down for SoFi is because of the split between financial services to lending products. It has gone more in the favor of financial services, even though both lending and financial services individually have been growing in their average revenue per product, okay? But the split is changing the results of the average revenue per user. Either way, Chime's market cap is around $11.2 billion, and SoFi's market cap around $14.8 to around $15 billion market cap as of the recording today. And you can see that Chime's price to sales ratio means that you're actually going to pay more for this company's revenue at about 6.22 times versus SoFi actually being about a whole 1x lower, even though they're growing faster on a revenue perspective. But this usually means that either growth rates, sustainability of growth, or their profitability is much higher. Let's take a look at that now. If we take a look at adjusted EBITDA, which the adjustments could be a little bit different between these two businesses, okay, you can see that Chime has just recently, in these 2 quarters here, broken profitability on an adjusted EBITDA basis, okay, where SoFi has been above the profitability line for the past 3 years, while only incrementally increasing how much profitability they actually see as of the most recent quarter now at 27%. For Chime, just breaking that 5%. And then on a net income basis, we also see very similar trends to SoFi, just a little bit worse, where we end up seeing both of them coming out of non-profitability. SoFi, once they broke it, they never did drop it, where Chime has seen quarters where they've been profitable, then that has fallen back into unprofitability and breaking back up above. See, I don't like that as much as what SoFi has done, because now we know that that part of them being not profitable is behind them. Chime, the certainty that they are going to now hold profitability going forward is not as certain as what SoFi is going through. Are they going to get back into the negatives of negative 20+% in net income? Probably not. I mean, they're probably going to stay somewhere around a profitability zone, but SoFi is obviously continuing to tick up and will probably even push higher than 10% over the foreseeable future. Now, my main problem with the SoFi versus Chime comparison, I mean, aside from just the facts that they're unprofitable, we can't compare them on an enterprise value basis because they use debt to actually further their growth, both on SoFi and Chime's basis. They have all of these ways that we just simply can't compare them very easily. Even on a gross profit basis or an adjusted EBITDA basis, the adjustments are different, and even the gross profit, the way that they assume what their gross profit is versus SoFi's contribution profit is also different. So it's very hard to compare them one-to-one on those statistics. But on the products that they're showing off, let's just go through and look at the quality of the customer that you see at Chime. And you can see the type of customer that they go after based on the products that they end up showing off, okay? And even some of them that are on here that they're not actually showing, I also want to talk about. So first off, what we see is whenever it comes to spending accounts, Chime's checking and debit cards are their main products. Then you can see a bunch of overdraft protection and instant loans or payday loans as the types of products that they offer whenever it comes to their lending services. They don't even actually offer a real credit card. They only offer a secured credit card and then a FICO scoring or FICO score tracking product to also incentivize their users to then grow their FICO scores and get better financial health, which I think is the right thing to do. It's a morally right company. The problem is that once they actually fix their credit, there's no solution that they can actually grow into. So then they look for a more upgraded service like SoFi to take them from there. The customers that are using Chime, and I'm speaking in averages here. If you use Chime, this doesn't mean that you fall into this bucket. This could have just been a company with a great user experience that you wanted to use, but they are usually on the lower end of the FICO and overall income earning segments, okay? And they're not needing products that are including lending products or invest products because they're just not there in their financial journey. SoFi, on the other hand, you can see in the products that they offer that they are leaning towards a more affluent user base. $3 million in FDIC insurance. You're not needing that if your customers don't have that amount of money, right? You can see a suite of credit cards. We don't even offer a secured credit card because the average customer has above 700 FICO scores. Invest products with a lot of private equity and things that have been reserved for the ultra wealthy, and many loans for people that are just coming out of school, okay, that are usually in law degrees or doctorates or these sort of things, where they can actually give you great advantages getting a private student loan over a federal student loan. See, that's the thing too. Most people don't even know where SoFi came from in terms of offering student loans. The only way to make it work for them in terms of offering a private student loan over a federal student loan is to offer a better rate than what the federal loan can offer. The only way they can do that is by offering it to people that have better FICO scores than the average of the federal student loans, because they don't look at you individually. They look at the entire student base as one individual group. So everyone gets an averaged rate. So SoFi actually takes advantage of that by taking the higher end band of customers and offering them a rate and then spoiling the average for the rest of the people. But I mean, as a SoFi investor, that's what you want. I also want to talk about some of their other products like SpotMe. This is a product they've been working on a lot lately. And I think that it's actually a morally good product. And if I was in that sort of financial situation, that this would be the products that I would want to have as a user. The problem is that to even offer a product that helps you with overdraft fees means that you do not have money in your account at the time. Okay. These are not the product or the types of customers that make banks or financial institutions a lot of money over the long periods of time. Okay. They can by, charging them hidden fees or interests or instant withdrawals because they need that because they're living paycheck to paycheck, which is how Chime makes a lot of money. These sort of products make good money, but also really you want to service more of a higher net worth customer to really bring in the millions or billions of dollars over time. Another product that they end up talking about is second chance banking, which as a product that is deserved in this world, I think that it is a great idea. Okay. This is sort of offering banks to people that potentially were bankrupt in the past or have criminal history or something like this, right? Second chance banking overall for the society is a great product. But it also means that the types of people who are getting onto the platform might have a harder time growing the asset base or the deposit base versus another company like SoFi. Whenever you compare this to another industry, let's look at credit cards exclusively. Capital One versus Amex, which I actually think will be a good comparison for both SoFi and Chime. Usually the market ends up favoring Amex. Lower default rates, less risk, more sustainable or expected earnings over time. Then, as these companies start to reach their serviceable addressable markets or SAM, then they start to have to find new products that they can sort of go after a new audience base. The truth is that Capital One has an extremely hard time growing up market, trying to attract ultra wealthy or just more affluent customers than what potentially Amex has been able to serve. But Amex trying to work their way down into lower end markets has been an absolute breeze because it does have that brand recognition that the customers want to use Amex. And if they can actually get accepted onto their platform, that they would love to have that brand be a part of their financial solutions. If that is akin to what we're going to see between SoFi and Chime, I think it's going to be very easy for SoFi to offer secured credit cards and more FICO building products than it will be for Chime to start offering better, financial solutions for more of the affluent customers that they might try to go after into their later future as they start to actually serve their serviceable addressable market. Overall, I think both companies, I mean, not stocks, are absolutely fantastic. Chime's helped a ton of people. SoFi has helped a ton of people. It's absolutely amazing. But whenever it comes to the stocks, I'd rather get the more affluent, faster growing, better profitability at a lower valuation than try to buy in this IPO. We'll have to see how the market reacts, either boosting up SoFi stock as a comparable or bringing down Chimes even after just going public, but we'll have to see how that turns out.